Hey there, it's Dean Odell with Seven Gables Real Estate in the Odell Group. Today is December 23rd, and I'm coming to you from my office. No, not really. It's just background. I'm actually visiting some relatives for Christmas out at Phoenix, heading back today, but I wanted to get this done for you guys. I promised you guys I was going to try to get this done for you, and I have spent a tremendous amount of time analyzing the market, going over different forecasts. I've been through the Chapman forecasts. I've been through John Burns Consulting's forecast, one of the best forecasts around for the Orange County area, along with Chapman's. I've been through Keeping Current Matters, which is a national forecasting, all kinds of different avenues I've looked at to try to lay out for this market where it is going for you guys, because we know there's a lot of chatter out there. There's a lot of crazy things going on in the economy, but we're going to stick to the facts. We're going to stick to data. We're not going to stick to crystal ball gazing. Okay. So we're just going to go with what's out there and what's real right now. Of course, that can always change. So let's get started with this. I'm going to go ahead and share my screen because I'm doing this via Zoom, and I have laid out some slides for you guys that I want to show you. When they took this survey, which just happened, 72% of the people who believe the housing market will crash think it's going to be as bad or worse as the 2008 housing collapse. Now, those 72%, those are comprised of the 41% of Americans who believe the housing market's going to crash in the next 12 months. So we have basically 4 out of 10 people that are walking around out there thinking the housing market's going to crash. And out of those, we got 72% that thinks it's going to be really bad. So that's almost 3 out of 10 when you multiply them together, right? Now, 58% of that group expects a housing crash in the next year. They say they're postponing housing related changes. Okay. So that's what we're seeing. We're seeing a lot of the market just kind of wheel back and try to figure out what's going on here. So I'm going to try to provide some clarity. So let's move on. Number one, let's not trust the headlines without the proper context, right? Because we know, there's clickbait out there on the internet. Everybody wants to get everybody excited about everything. And we all know what the news is like, all the different opinions and everything. So that's why we stay with the data. So let's start examining that. Okay. We keep hearing foreclosures are up, right? Okay, well, yes, foreclosures are up. Foreclosures are up from historical lows, you guys. Let's look at these numbers. Look from 2003 to 2022. That's nationwide, the number of foreclosures. Now, in 2003, was anybody screaming that the housing market was going to crash? We all know it didn't happen until later on, right? Like 2007, towards the end. So we have less than 1/10 of the foreclosures we had back in 2003. Nationwide. So for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the Mortgage Bankers Association survey began in 1979, declining to 3.45%. Foreclosure starts and loans in the process of foreclosure also dropped in the third quarter to levels further below their historical averages. Okay. Now, you would never know this from the headlines out there, right? Everybody's talking about there's going to be all these foreclosures. It's going to be horrible. We're just going to repeat the great housing crisis again. No data to support that at all. How about credit card balances? Everybody's talking about, oh, consumer debt has zoomed. It's so high. It's just crazy, crazy high. Well, let's look back to 2019, third quarter. We are right back to those levels. There was a lot of stimulus, a lot of money. People weren't spending money. People were saving money. Okay. But the reality is everybody's just going back to how they used to live, spending the kind of money they used to spend. And I've said it before, the only thing that's going to get us in trouble in this economy is if people start losing jobs, high paying jobs, the people that are buying housing, that can't afford housing, they start losing their jobs, then we're going to have real problems. Let's go to the next one. Though delinquency rates are rising, they remain low by historical standards and suggest consumers are managing their finances through the period of increasing prices. Okay. So we all know inflation is taking a bite out of everything. And then on top of that, we got rates going up, but the consumer is actually faring fairly well when you look at the consumer who will be buying housing. This is a little comparison chart to show you that today is nothing like it was 15 years ago. Okay. And these are the key variables when we compare them. Look at job cuts. Last housing cycle, we can see that row. 8 million job cuts versus basically none in terms of what we've had. We're looking at net, okay? It's a net. How many gains versus how many lost, right? So now we're hearing rumors there's going to be job cuts. So that could be a game changer. But right now, a lot of that's crystal ball gazing, right? We know there's going to be a recession, pretty darn sure of that. So we're just going to have to see how bad that gets. But as to where we are right now, this is how far off we are from where we were. Okay. Total jobs got 138 million. In the last cycle, we got 20 million more jobs now than that. Subprime loans, they were everywhere. All you had to do was fog a mirror. Now, not anymore. It was built on the back of really solid lending. We have virtually no subprime loans, right? New construction, this is nationwide. We had an overabundance of housing units. Normally, we sell about 5 million housing units nationwide. So look at that. There was an extra 3 million that they had versus now we have 4.6 million. Extra 3 million, that's a lot of housing units, right? That's probably 60% more than we need or so, right? Inventory on the market. Look at how many houses were listed back then, 3.8 to 4 million versus 1 to 1.2 million. Now, I know what you guys are saying, well, this is all big, like macro stuff. I live in Orange County. What do I care about all this stuff? Well, we got to pay attention to the macro, and then we'll bring it down to Orange County. So that's coming up. Mortgage delinquencies, they were 10% in the last housing cycle. They're 3.6% now, which we already know is near historical levels from the previous slide I sent you. Homes in foreclosure, 4.6. Right now, homes in foreclosure down to 0.6%. I mean, it's almost non-existent, right? Now, 2022, what happened? Well, interest rates dictated everything. We had low rates. The market was going crazy. Look where we started out, 3.22% on the left side. We went all the way up, hit 7% a few months ago, and now we're kind of settling back down right around that 6.5 range, okay? But this had a big impact on how crazy the housing market has been the last couple of years. As far as interest rates go, for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year yield, and it's no different today. It's the same thing. So what we do know is we know the historical average is right about a 1.7% difference. So if you really look at where the 10-year treasuries are now and where the 30-year fixed rate should be, it should be lower than it is right now. There's built-in spread there, because the investors in these mortgages, they know that they're going to be refinanced. They're going to be short-term deals. There's more risk in the economy. So the premium or the yield spread is getting bigger. How much bigger? This is where rates should probably be right now, right at about 5.5%. Instead, they're closer to 6.5%. So we've got this bigger spread. You can see in the middle, almost 3% versus the historical 1.79%. So what do you think that's going to mean, long term? Well, because we see a slowdown in the economy and we see the inflation comparisons start to become more and more favorable, you'll start to see that the inflation numbers move lower, lower, and lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or below 5% within the next 6 months. Mortgage rates could pull back meaningfully next year if inflation pressures ease. Now, we're already starting to hear that inflation pressures are easing, right? So we're already starting to see mortgage rates roll back a little bit. So they're continuing on this downward trajectory. They were at, November 10th, they were at 7.08%. Now they're at December 15th, they're at 6.31. And everyone was freaking out because, the Fed was going to raise rates again. They were going to raise rates again, okay? The Fed is a short-term rate, you guys, okay? We're talking about long-term. And right now we have what's called an inverted yield curve, which means our long-term rates are better than our short-term rates in terms of when you compare them. That's why we can be pretty assured that we're going to have a recession. If you listen to James Doty's Chapman forecast, he's got the recession projected at 98.1%. But if you guys also remember some slides that we've shown you in the past, just because we have a recession doesn't mean prices are going to go down and like crazy. Sometimes by the time you get into the recession and out of the recession, most of the time you've still had some sort of appreciation. So yes, we're going to have a decline in prices. Yes, we've already seen a decline in prices. Are we going to have a housing crash? Well, a lot of it's going to have to do with these mortgage rates. I mean, you could see the trend right now. It's going down to 6.3. We usually overcorrect when we come out of a recession. So we could maybe dip into the fours again, 4.5, but 5.5 is where most people are thinking we're going to be. And 6% is probably getting back to kind of a normal level for the supply and demand levels that we have. Okay. So this is what the home price forecasts are nationally. And we'll talk about Orange County later. But as you'll see, people don't agree on anything, right? So we look at the averages, okay? If we look at the averages, looks like prices are going to be fairly flat this year, right? And you can see all the different comparisons there. Of course, realtor.com projects the highest one, right? The guys that, the realtors. Realistically, Zellman, she's a great forecaster, very, very popular. A negative 5.1, she's probably going to be closer to being correct than anybody else if I had to guess. But if you average these together, you've got almost flat prices for 2023. And we'll talk about what's going to happen in Orange County because it's a little different. So the housing market, just at the new of higher mortgage rates, will benefit from continued strong demographics driven relative to an overall long run shortage of supply. So we have a supply issue. We have demand going down, but we still just don't have nearly the supply we need to even support the demand we have. And that is what's contributing to prices not cratering right now. And we don't have a whole lot of inventory. Okay. So let's keep going. From our perspective, the good news is that demographics remain favorable for housing. So the sector appears well positioned to help lead the economy out of what we expect will be a brief recession. Chapman was right in line with this as well. They thought this could be maybe a 6 to 12-month recession. It's come out of it. Anybody who says we're not going into a recession, I'd highly stay away from that kind of talk. I think we could argue we're already in one, right? So let's go to the next one. Okay, now we're looking at Orange County. We're getting back into our specific market territory, right? So when we look at this, back in 2007, that was our active listing inventory level. You can see at the height of the crisis, it was 18,000 homes. And this was the regular curve down to 15.5 in the winter where we are now. So that top line is what happened right before the downfall in the housing crisis. Look at where we are now. Look at our orange line here. We peaked at 4,000 homes this year. And today we have 3,182. Okay, does that look like a housing crisis to you? Compare those numbers, 4 to 18,000, 3,182 to 15.5. Where were we last year? Well, last year we were at historical lows. We still are at historical lows. We're not even near our 3-year average, So, how is this market going to crash in prices drastically? Like, people are talking about 40% cuts in prices. I mean, it's just, there's no way. There's nothing in the data to support that. Now let's look at the demand. Okay, so if we look at this demand, we can go back to the demand levels. Again, you see that 18,000 at the top. That was the inventory, the light blue. Now look down that same line going all the way down and look at how low demand was back then. Demand was probably on target with where we are now. So for us to be in a major housing crisis or have one, we'd have to keep demand where we are now, and we'd have to have about 4.5 times the inventory we have, a 450% increase in inventory. I want someone to tell me where that's going to come from when you have people with lots of equity in their homes, foreclosures at an all-time low, defaults at an all-time low. Where's all this inventory going to come from? In the end, it's a simple supply and demand, you guys. And so let's look at, another reason this time of year we're seeing our inventory build, is we're seeing homes pulled off the market. Even in a bad market, 3,500 homes were pulled off the market in a year. Normal market, 2019, that was the last normal market we had. About 1,000 homes were pulled off. This year, 750 homes pulled off. So we're still, we still don't have the inventory. We're just below on everything. We're just slow, very slow. Let's look at Orange County distressed listing. Again, peak, 6,000 homes. Can you imagine? 6,000 homes that were on the market back then, and 8 that were distressed, that had no equity in them probably, or very little, certainly in foreclosure. Now, you look at November, there were 12 homes. That's it. 12 homes in Orange County versus 6,000 back then. You guys, we are not in a housing crisis. Okay. Orange County distressed listing breakdown. Okay. Let's take a look. Total distress listings, you could see there's that 6,000 again back in '08. Then you could see how many of those were active short sales. It seemed like all we did was short sales back then. It was horrendous. It was terrible. Nobody had equity in their houses. We'd have to go to the banks and ask them to sell it for less than they were owed. It was not fun time. Now, if we look where we are, look at the active short sale listings, look at the active foreclosure listings, which are in the darker red. But as you can see, even in a bad market, there were, 1,000 foreclosures. I mean, they don't want these foreclosures to come to market. They know what it does to prices, right? So they do workouts with the buyer. They extend the loan, they refinance them. They do anything they can to not have to foreclose and take the house back. So there's like everybody super hopeful that all these foreclosures are going to hit the market. Please, put in the comments, where are they going to come from? Because we're not seeing them. Nobody in the industry is seeing them right now. Okay. Only the crystal ball gazers who want to, compare everything back to the Great Recession, which this is not even similar. Okay. Orange County demand year over year. Here we go again. We've got our orange line now at 1,133, extremely low demand, extremely low, right? So if you look back at 2019, which was the last normal year, you could see we were up closer to 2,000. So yes, there's definitely less transactions going on. Okay. But guess what? We know there's less inventory. There's less houses to sell too. As a matter of fact, I don't know if the stats in this presentation or not, but I remember from Orange County, it was crazy. We're down 36% in inventory and we're down 36% in demand. So it's kind of the same thing. It feels the same. It feels the same as a normal market, I should say. Not feels the same as what we just went through the last 2 years. But the last 2 years was not normal at all. Okay. And people have to just get up behind them. They just think like the market's horrible because everything should be like it was the last 2 years. It's not how it works, guys. Not how it works at all. So Orange County demand, again, you could see this low demand figure right here. And it's because people are on their heels. Prices are up. Interest rates are high, a lot higher than they were. They've doubled. I mean, that's going to have an effect. It's going to bump a lot of people out of the market. But then there were a lot of people that, were buyers only because interest rates were low. That's what made the market so crazy. So now we're kind of getting back to just normalizing things. Now, this demand, it's interesting. We had a really good December in our office this year. We had a lot of sales actually, and some big ones too. And, the reality was we saw interest rates start to go down and we saw immediately the market respond. So it's going to be interesting to see what the next figures are that come out for the whole month of December. But we did have a little bit of surge there because rates went down. But you see, again, like I told you, back in, 07, 08, that was when the demand was about where it is now, only at 1,100. So everybody's freaking out. But it was also that way in 2020. So yes, super low demand, but also super low supply. Okay. Orange County expected marketing time year over year. We've got 84 days now. We're getting back to a normal market. What's a normal market? A normal market is a balanced market. Look at the legend here. 90 to 120 days is a balanced market. We're at 84. Where were we the last couple of years? Well, look at where we were. Red line and green line, very low, below 40 days. Okay. That was a hot seller's market. That was an insane seller's market. Fun time to be a real estate agent, obviously, but not really the type of business that we want to see continue. We think it wasn't healthy for the market and we needed to get back to normal. And hopefully that's where we're headed. Now let's look at the expected marketing time when the market was bad. 460 days back during the Great Recession versus 84 now. Come on, guys. This is not this is not the same thing we're experiencing here. If you want to tell me it's going there, okay, I'll listen. Where's the data? Give me the data, not just guesswork. Okay, let's go to the next one. Okay, Orange County closed sales. Again, this just demonstrates this is demand is escrows, closed sales are what's actually closed. So we know we just closed 1,700. Last time we closed 1,700, yes, it was during the Great Recession. Okay, but you know what? Again, this isn't the Great Recession because back then, there were 8,000 homes to choose from instead of 3,182 right now. Okay. So buyers had a lot more selection. They just weren't buying and prices had to come down because supply and demand got completely out of whack. And we're just not there yet. We don't have this huge supply level. Now, could we get it in the springtime? remains to be seen. Maybe there's a lot of people out there that are thinking about selling. We are starting to get some calls for next year, and we know some people that are ready to go. But I can't say it's like a huge increase from last year at this time either. So it's, we always kind of know where the market's going by the time we get to, the springtime. But right now, a little too early to tell. Based on the data right now, I know we're looking backwards, but this is pretty current data. So something's going to have to change pretty rapidly, and we're always going to tell you when it's changing, right? So Orange County closed sales by year 2022, 24,000 homes were going to sell this year. Again, demand down, really down, right? Last year was 35,000. Year before that was 30,000. If you look at when the last time we did 24,000 homes, again, 2008. So yes, there are some things here that are looking like the Great Recession, right? Okay, the numbers. But the reality, people didn't have 2.5%, 3% mortgages. People right now are hunkering down in their homes. They don't even want to sell them. They've got such good mortgages, right? So people are staying put. People have a ton of equity in their house. Okay. People are not stressed that they're over on their house. So there's a lot that are contributing to not having this inventory. But the reality is, and it's be about supply and demand. I mean, that's it. I'm not sitting here preaching you the prices are going to go up, but I am telling you that as of now, we don't see enough inventory to tank prices, like really tank prices, like people think what's going to happen. We're going to have to see something rapidly change. Orange County closed breakdown. Again, talking about equity, that green line, almost 100% of the people had equity upon closing. Almost 100% of the people. You go back, you compare that to 2008 Great Recession. Look at this. Only like 38% of the people that were closing escrows back then had equity. That's what you call a distressed market, you guys. What we're in right now, not a distressed market. It's a slow moving market because there is muted supply and muted demand. And when you put those two things together, it's really just a balanced market at this point. Okay. Now, I'm not going to tell you that interest rates haven't taken effect and it's bumped a lot of people out from being buyers, but there are still buyers out there. Okay. So hopefully this doesn't run too long, but there was a lot of data to absorb there. So the housing forecast for Orange County, what they're calling for from top to bottom this year was approximately 15% drop in prices, of which they think almost 10% has already happened. So most people that are forecasting Orange County are forecasting Orange County to have about a 5 to 6% drop in prices this year. Now we'll see if that is true or not, but that's the forecast. And until we see a lot of inventory come on the market, I just don't see how we're going to tank prices much more. If I had to guess what my opinion was, I'd say we still have another 10% to go. But you know what? We're selling houses. So these people that forecast for a living, they're not always right. But when you take a consensus of all of them and put it together and come up with an average, it's usually fairly accurate. Right. So we're going to go with the data. We're going to go with the average of the forecast. And we're going to say that, Orange County next year, it's going to be a slower year, but it is not going to be a market crash, you guys. And the national forecast is calling for the same thing. So that's about it. If you guys have any comments, I'd love to hear them. And that's about it for this 2023 forecast. So that's the best I got to give you right now, you guys. So anyway, we'll see you guys soon on the next Tustin Talks. See you then. Bye-bye.